A lot to be thankful for this Thanksgiving weekend. Welcome to the Gray Report. One thing I'm thankful for, Matt, you thankful for all the work that you're doing on the Gray Report, the show, everything here. But no, we obviously couldn't do this without you. Thanks. So very, very thankful for you and for the show and for everyone that actually watches and listens to the Gray Report. It is, again, it's incredible. It never gets old, when you meet somebody who I'm thinking we're meeting for the first time. But they're like, oh, I actually, listen to you and Matt on the Gray Report. I'm like, that's just so really cool. So thanks everyone again who has liked, subscribed, leave a comment. Haven't done it. That was a great opportunity, and thank you for that as well. Matt, many are saying that maybe turning a corner in the economy with ideas of, maybe the rates are going to be lower in the future. Mm-hmm. Maybe it might be a time to buy. Are things turning around? Many saying not so fast. And so, again, just a couple of really good articles and reports to help us paint a little bit of a better picture. So from Newmark, I'm looking at the United States multifamily capital markets for the third quarter. From Bloomberg, a piece on, Bloomberg via Yahoo Finance. Who gets the credit, Matt? Bloomberg?
Bloomberg gets credit.
Yeah, Yahoo's just, what? Okay, so why are we using the Yahoo Finance piece? Doesn't matter. Private credit titans are grabbing more than a half of new deals. It's a good starting point. Cushman & Wakefield, a piece, Market Matters, CRE markets in early stages of adjusting to higher interest rates. A really great kind of list of kind of some of the factors that are really kind of shaping the market and helping shaping some decisions as investors are trying to figure things out. Just, on a daily basis, where are we going and what are the right moves as, things are still maybe skinny. There's uncertainty, but again, there's glimmers of light kind of at the end of the tunnel. Now, we've also said that there's some other big structural things that we have to get through that maybe we're just beginning to. So trying to, understand it a little bit more, Matt.
We're going to figure out what the future holds and we'll chart a good path to it.
So, all right, so if you're a multifamily investor, active or passive, you're in the right spot here on the Gray Report. We're going to be breaking down all the latest research reports every single week, so we really appreciate it. Trying to help collectively make some really well-informed investing decisions. Okay, Matt, let's just jump into these reports. Let's do it. Welcome back to the report, Matt. How's this week going? How have you been?
It's been good. We're recording a little bit early, but I feel like I kind of jumped into this week pretty with both feet on the ground, as it were. really hit the ground running.
Yeah, excited to get a lot of things done before things start slowing down, and really it marks a time in the calendar where it's hard to get a lot of things done before the end of the year, although all of a sudden you start thinking of all of the things that you would like to have accomplished, the conversations that you want to have before it gets busy with just the holiday season. It's starting this week, but long list of things to do, and some of them are new, some of them are old, but a lot of the desire to kind of get things done. So Matt, let's just hop right into and get started with this piece from Newmark, United States Multifamily Capital Markets Report from the third quarter of this year. Yeah. Always looking forward to these reports, and there's been a decent shift in capital market activity, to say the least, over the last really 18 months now. So what are some of the big takeaways?
So they do comment on they've got some great general observations and highlights at the start, but I really zeroed in on some of the information they had early on new construction. They have a different way of figuring out what's getting built and the new supply of apartments compared to other places, and we have a little bit of a comparison too. But regardless of that fact, they, like everyone else, is talking. They are all talking about the huge numbers of constructions that we're getting in 2023. That's no argument, but whether that is a peak or whether we're going to start falling in terms of new completions and new units delivered, that remains to be seen. What they're saying that the record which they say that 128,000 in Q3 of 2023. They say that record is poised to be broken several times in the next handful of quarters. At 2.1, inventory growth is 70 basis points above the long-term average, and that's expected to climb to 3.4% throughout 2024. And the graph right here, you can see in the next 4 quarters, it really will peak at 176,000 in Q2 2024 and not really settling down until Q3 of 2025. Yeah. So that's like when it kind of gets back to normal. Now for an alternative, for an alternative perspective, the CoStar's data has Q3 deliveries at 152,000, dipping down to about 131,000 by the end of Q4 this year, and gradually falling each subsequent quarter until bottoming out in 2026 in Q2 of that year at around 61,000 new units delivered. The Newmark report doesn't go that far into the future, but ultimately it kind of gets to the same place. The key difference is that Newmark is predicting another record year of multifamily supply in 2024, followed by a steeper drop-off, whereas CoStar projects a steadier decline that starts essentially a year earlier than Newmark's forecast. I wonder why there was that kind of year difference. It's going to be interesting, and maybe CoStar kind of anticipates a slowdown in construction that's spread across multiple years, because they're both dealing with the same, it seems like they're both dealing with the same raw numbers. They're publicly available numbers of permits, starts, and what's the other one? Completions.
Yeah, completions.
Okay. All right. Yeah. So that's So there's different stages, and they all kind of give you a little bit of different information.
Because looking at deliveries and demolitions, we can also look at the actual starts, and I think this looking at the starts, it also really helps paint I think the picture of not necessarily this year or the next maybe 12 months, but looking out really kind of 2 years into the future. Just look at the fourth quarter of 2023. This is quarter to date, so this number could come up a little bit, but every single quarter, really going back since the beginning of 2022, Q1 of 2022, which was really kind of the peak, it has been declining. We kind of got back into, really halfway through this year, kind of that historic average, somewhere around, call it 100,000, per quarter. It seems like we're being started, but after that, really dipped down to decade low, and now we were beyond a decade low so far for the fourth quarter this year. So
that's the homework question I'm going to give myself is how many of what percentage of starts never get completed? What percentage of permits never get completed? So,
and that percentage is going to go up in an enviravement like this where credit and financing is really hard to come by.
Very, very, very true.
According to CoStar, though, we've started to see the slowdown in units being constructed. But long story short, 2 years of anticipated weak demand, relatively weak demand, really depending on the market, which always we have to kind of qualify that every market's going to be incredibly different. A lot of this construction is concentrated in the Sun Belt and some of the large kind of gateway markets like New York City or so. Other markets in kind of the Midwest and even some Mountain West, Northeast, random Sun Belt markets may not have as much supply coming online. Totally depends on which market. We're talking about.
I like that you mentioned demand, because Newmark does have a little bit of an insight over the
whole
kind
demand driver.
Yeah, the way that I think it's on page 16, they talk about absorption, and they're measuring really what happened was this huge surge upward in absorption that was followed by a just as precipitous of a decline, and it really bottomed out in the first quarter of this year at negative 192,000 in absorption, and it is on its way back up. It's finally positive, but it's not nearly the same as the amount of units that are being completed. We have 127 positive, 127 in absorption, and 405 when it comes to units completed. And new supply that enters it. So vastly outstripping, but the trend is really interesting, and it shows how steep and how volatile, perhaps how sharp of an increase we still might see from
demand continuing to recover.
Yeah.
The demand drivers they continue to point to. It's not a sure thing, but just the affordability of renting relative to purchasing a home. And while renting doesn't seem cheap to most people, it doesn't on its face, but the rent isn't cheap.
Yeah.
But compared to buying a home, it is much more affordable. Yeah. And that's going to be driving on the margins more people to renting longer rather than making that decision to purchase a home because it's just not feasible at this given time. But I feel like that's a reality that's keeping things afloat and continuing to keep things moving. I find housing demand can be a little bit more like nuanced beyond being like, well, it's cheaper, therefore people are going to be doing it. And I think we're probably seeing overall general weaker household formation, even though that what we could have potentially see. I think we were seeing actually some decent household formation, but it could be a little bit stronger if there was a little bit more confidence on the consumer, whether to pursue housing and form that household and move out with their parents or even living together, whatever it is.
Very good point. And I've been thinking a lot about kind of consumer confidence and we'll note that in a separate part of I think that it's in the future article on Cushman and Wakefield, but I do think that this negative 192,000 in absorption early in the year, yes, that represents a kind of reaction to the high absorption as before and a return to the mean or whatever, the bounce back, but it also means this is a period of maybe pent up demand that we're seeing and finally kind of expressing as things settle into maybe we'll see about 300,000. We're at 127. We have a ways to go, but it could be a short period of time for us to get back to that level of absorption. But time will tell, are we going to see a recession? Is inflation going to, rear its ugly head again? What's there's a little bit of uncertainty, but I think that, it doesn't seem as dismal as it did a couple months ago. I was calling for a recession and I don't, maybe I was wrong.
It was uncomfortable. The only reason that makes me feel like there may be a higher chance for recession today is that so many prognosticators are saying that there's no way we're going to have a recession now. So I'm like, oh, okay. So you're saying now there could be a recession.
That's a good point.
Is that what? I'm just if you're going to take the opposite of what?
Soft landing has been in like so many articles written since the latest CPI report showed lower inflation. There's been a lot of talk about this beautiful soft landing, and I don't think the plane's ever really going to land. We may not land for a long time.
We're just going to be gliding. Just gliding, and are we there yet?
Yeah.
And I mean, we just looked, Matt. I mean, again, just relating the multifamily to everything else. Why not? But we all want it to be over tomorrow. Start doing deals. Just get back to the good old days. Well, it's not going to look the same. It's not going to look like 2018 or 2019 or 2016. We've got years to get. There were years to go through before we got to those points of where multifamily investing seemed like this sure thing that it has been perceived to be over the last, call it half of the last decade or so. You have to go back and remember in 2009 and 2010, 2011, like real estate had just crashed and the entire economy had just crashed. So not only do you have people uncertain and just getting ready for the next crash, because we were, everyone was saying, it's still a house of cards. We didn't really, learn all of our lessons, and we're going to be doing the same things, which, is partially true. But you just had people, get out of the space, look elsewhere, and weren't focused on real estate. And so, I mean, the next 2 years, I think are going to be some great buying opportunities because more and more people are going to be getting out of the market. Right now, there's still a lot of participants who are, banging their heads, against the wall or, hands up, fists on the table. There's a lot of, there's going to be people leaving the industry over the next kind of year and a half or so. And I think that we're going to be approaching good buying opportunity. And that's what I know the Cushman and Wakefield piece talks about also kind of later on. Yeah, there's going to be a lot of good deals done in the next 2 years. I don't know if it's like right this second, whether it's 3, 6, 9, 12 months, but getting into 2026 once this wave of supply, has crested and is starting to subside, we're going to see some really good growth similar to what we saw kind of back in 2013, 2014. Once we finally started that pickup and demand really returned and there wasn't that much supply coming online.
Yeah.
We had a couple really solid years, again, kind of around that 2013 to 2014, even to 2015 of just solid growth. And then it kind of like normaled out and it was kind of steady Eddie. And then that's when people started really getting into the market because, the cap rates had risen enough, going back to the great financial crisis, and interest rates are still relatively low, that people started doing the deals that were throwing off the returns, which caused people to continue doing those deals and people to fall in love with the space. But, your typical deal, had an 8 pref and was throwing off, 8 to 10% cash on cash or really solid yields, and people were underwriting to, mid-teens IRRs, 16, 17. That was a, good looking deal. Yeah. But they ended up all, delivering kind of 30% IRRs, and the deals done earlier in 2009, 2010, and 11, those were, 60, 70% IRRs.
Yeah.
So I think we're approaching a really exciting time. I don't think we're there just yet because again, not enough pain has occurred, and we have to get through. We have to get through all these loan maturities that we're waiting through. And I mean, Matt, we're not talking about this right now because none of our deals are facing it. But the reality is there's a lot of deals that are blowing up right now. There's capital calls going out, just across the industry to LPs. And that's a little bit of a different topic than exactly what we're talking about here.
It's happening throughout the economy too.
We have really not seen the full effect of the higher interest rates to filter its way through the economy, and rates are not coming down so quickly that's going to kind of alleviate some of those concerns. So that's why I'm very cautiously optimistic. Yeah. I'm optimistic.
It's going to look bad, but it's going to be good for investing. I think that,
and again, and Mark, like our words, 3 weeks from now, 4 weeks from now, Matt, there's going to be the talk of something else, some other data point's going to come up, and we're all going to be pointed towards recession. And so we need to have the clock that we just kind of move around, where we are in the cycle.
Well,
the macroeconomic, soft landing to recession conversation.
And at every hour, it's like, oh, there's a chance of recession.
Yeah.
I do, but even speaking of multifamily, it almost doesn't really matter if it's a recession or not. And in some cases, I think people were looking for that recession so that it would lead to the Federal Reserve being able to lower rates and deliver on that.
A little hard reset.
But right now, in the multifamily world, the 61.7 year-over-year decline in quarterly sales volume. That's bigger than the one that I noted when we were kind of correlating it with the Mortgage Bankers Association data. Loan originations were down by 51%. But if you're talking about the investment sales market, and this is new March numbers, 61% year-over-year, 62. Let's round up. But yeah, it is a decline year-over-year, and that's also a big enough decline where it's well below normal. This is below what it was like in 2019 and 2018, or like the pre-pandemic normal, and certainly below the fever dream of 2021. It's pretty low, and it is low for a reason. And this is this period of adjustment that I want to kind of talk about with Cushman & Wakefield. But it means that investors are not jumping in as much as you would think they are. And it's not like, any buyer can find any seller can find a quick buyer. Dry powder is reduced, but still high. And I just think that this is an interesting counterpoint to the idea that pressure is building. There's still a lot of pressure, but it's not an illogical or irrational.
I see that the capital is thinking about finding a home, but they're not eager to pull the trigger. I mean, maybe some conversations on like income. Need to get forecasting next year's income to a certain level, so we need to make sure you have certain investments to cover that. If you're in retirement and you're looking at fixed income and those types of questions. But again, treasuries and money markets can do a lot of that for you without taking much risk. And I think people are being opportunistic on very discrete scenarios and situations and opportunities, but they're very skeptical. They're not trying to write a big check. And again, I think there's an anticipation of there's going to be better opportunities, which mean that things have to get a little bit worse before.
I agree.
They get better. Now, we could be wrong, and again, the soft landing that never happens, and then just things start kind of slow boiling up. But again, I think we got to get through. We got to work through some of the issues that we have. We're not going to work through all of them, but I think there are still a handful of things working the right.
And as
system.
and CoStar even also projects further price declines for multifamily properties into 2024 too.
Yeah.
And I think that may be, the middle of 2024 when we have seen, maybe 2 full years of stagnant rent growth, where there's no real way to kind of mess with those income numbers, where it seems like you're not going to make anything on this property well.
And we really should start seeing some of those declining sales numbers, like at the end of really this year, kind of getting to Q1, because like when we hit 10-year hit 5% essentially a couple weeks ago. I think there was a lot of retrading that was going that whole period, which rates the 10-year has come in since then. So maybe it did not affect as many deals, but that certainly soured the market. It was a psychological level to a lot of folks, whether it's sellers, buyers. I know of a handful of deals that blew up, because of that. They're going to eventually trade at lower prices. Some probably just were retraded for lower prices. And we're certainly not going to see a quarter of lower cap rates or higher prices. And then, what does Q1 hold? We're not there yet. One step at a time. It'll be I am maybe looking forward isn't the right term, but it will be really interesting. It'll be very interesting to see the mood at the National Multifamily Housing Council's annual meeting at the end of January. Yeah, because the one that happened this last year in 2023 at the beginning, most folks were pretty positive. Really,
this thing will just blow over.
It's fine. We're most likely seeing positive rent growth of the year. It's a year of just normalization. The idea was that sales volumes were going to not decline, but they're going to go back to their historical norms. Yeah, rent growth is going back to historical norms. But
this was made. This were a prediction made in January 2023. Right.
Yeah. Exactly.
They'll settle down.
And so they were right in calling it a year of normalization, but a better term would have been mean reversion. Yeah. To get back to normal, you went up. Then to get to the center point, you got to go down. First, and so that's more of what I think that we've been experiencing. So was not. So the tenor. So in past years, the tenor's been very positive. Again, I remember, and then, the 10-year was still kind of mid-3s at this point. But I remember everyone getting excited. It's like, the 10 years come down over the last 3 weeks, and it's 3, 4 or something. So we're feeling positive that it's going to be a really good year. And 180 basis points later, 150 basis points later, we're here and dealing with it. So the attendance numbers, but again, just like the mood and people. I mean, we were talking about loan maturities, coming up and expiring, but no one else in the industry really was.
We were building Noah's Ark, and everyone else was, this is just a passing shower.
Yeah. Did we get two?
We didn't get not yet. Well, we got to get two of every investor. That's what we need.
Every kind.
That's right.
So we'll take a few. Everybody's invited. Okay, Matt, let's just pop over this Cushman & Wakefield piece. It's good. It's a good one. Right?
Yeah.
Stick around for this one, everybody.
So we're kind of talking about what happens next. Yes, credit's tight. Yes, interest rates are high, and people are looking. That people are kind of looking for deals. Sellers aren't ready to buy, but we are in the beginning moments of an adjustment period, and for Cushman & Wakefield, we're getting into this pause and pivot mode that they say for the Fed, which will give CRE markets the predictability, clarity to enter this price discovery mode. And lest anyone misinterpret what price discovery means, I think that I really like this quote here. It says, rate cuts should not be misconstrued as the ultimate savior. Policy rates will ease allowing for the yield curve to eventually uninvert, yet policy and base interest rates are not going back to zero. They're going to normalize and settle in higher than they have for the last decade. That's it really. It's kind of this higher for longer. And we mentioned this last week when low inflation numbers led to a stock market rally where it just seems like everyone is looking for the slightest excuse or the slightest sign that interest rates will go back lower. And they're getting, I think, maybe a little too excited and too expendy. And I think that makes the Fed really scared if they take it down.
There were some comments by a Fed official, I think from yesterday, trying to throw some cold water on that idea, that essentially saying that, December rate, a rate hike in December can't be taken off the table. But to me, it seemed like a really clear just attempt of trying to throw some cold water on it because things are starting to heat up, and I believe the markets now are projecting a 0% chance of a rate hike in December, and so they're trying to not let inflation pick up, and hopefully getting too geopolitical, but a potential ceasefire in the Middle East could potentially be good for long-term non-inflationary pressures, back not getting into the politics of the conflict there, but typically, wars are inflationary. And so if we don't have to be dealing with another front that and disruptions in the Middle East, which could eventually turn into, higher oil prices, et cetera, could be a good thing for the economy and not having more inflation.
It is interesting to think about what are the drivers of inflation, and we've seen the CPI, and there's a PCE, a personal consumption expenditure, and there's also a survey of consumer expectations that the New York Fed does of what inflation is going to be in a year. And basically they have 3.6% is the average of expectations. And it breaks down a little bit with higher education and income levels correlated with lower inflation expectations, landing on 3.2, which is what CPI is. But lower and middle income and education levels have it at 4%, which is higher. And it does seem like they're feeling inflation a lot more.
I mean, that makes a lot of sense.
Yeah.
I mean, the smaller the income, especially on a lot of those, just consumer, non-discretionary, items, food and gas and, your rent, even though it's, try telling somebody, it's like, well, your rent it's not as bad as if you were putting a down payment on a home. It's like, okay, well, my rent is still expensive. I don't care. Comparing me to something I'm not doing.
I don't care.
So, whereas, if you're raking it in, at some point you don't even know what the price of milk is, and so you're and maybe you're paying if you're making over $100,000. Maybe you're looking aware of what CPI is.
And the price of food is a much smaller.
Exactly. Even if you don't know, it's not hitting you as hard as someone who's making,
and this is directly relevant for multifamily because this kind of below 100K a year income is a little bit more in the audience or the consumer base of apartment renters.
At least, especially in workforce housing, I'd say 50 to 100K is more, you're kind of more B class. Well, you got all the classes here. So that's one of the good things about, if you've got a A-class development and an A-class location, that often you can sometimes have a resident base that doesn't care that much about price. We did a deal. This isn't like our textbook deal, but we did a deal where, I described the prospects as those that when they're searching for something in an apartment, they're searching highest to lowest, not lowest to highest. They're like, show me the most expensive things. I think I just want the nicest thing. And I might not, if there's a better thing for cheaper, I'll maybe consider that, but just show me the nice stuff. And I'm just less price sensitive, I guess. Any more on this? This is a lot.
So I did want to note just a little bit. If we go back to it talking about this adjustment process. Urban Land Institute called it, this is the Great Reset, or they famously and very articulately, beautifully, I would say, described it in their yearly report on CRE markets. And so too does Cushman say that we will be going through this adjustment process. And it's in its early stages, and the CRE capital markets are in the process of feeling the full effects of normalizing, in parentheses, rising interest rates. And for clarity here, it's important to repeat what Cushman and Wakefield are saying. Markets are still adjusting to rising interest rates, not falling ones. And just for even more clarity, and maybe a leading question, and maybe an obvious question, but what was this adjustment mean? I guess I'll just pose it to you directly. What would this adjustment mean to higher interest rates in the CRE markets?
Well, I don't think it means the prices are going to go up. It means that finally, the emperor will be declared to have no clothes in many cases, and some of the value of some of these assets just are not going to be what sellers want, and the writing will be finally etched on the wall, for all to see, of kind of just general where things are trading. Because right now there's still a huge spread, and we're seeing the spreads between the different types of assets starting to really wide. At least anecdotally, I don't have a report to show this, but the properties, the nice stuff, great locations, relatively newly constructed, not always, but oftentimes best markets, they're going for a premium. They're going for, 5 caps. They're going for even a little bit below 5, mid 5s, that kind of range. I hate to even say 4.5, but there probably are some certain level of intelligence folks that are, I don't know, maybe they're probably smarter than I am, to be honest. Maybe they see something, but still some deals being done at some high prices. And then there's also deals being done at, kind of 6.5, even deals being spoken about, kind of in the 7 cap range. So you're seeing a really big spread now between kind of different product types. And again, the stuff that is, less attractive, built before 1980, sub 200 units, especially sub 150 units. There's just not a lot of folks that are, jumping up and down for that. The interest is in the kind of in the early 2000s to brand new, something that's not too old, that looks nice, that you're not going to throw a ton of money into it. In a market that is growing, but the problem is everyone is targeting the same stuff. Again, mid 2000s to brand new. That's what everybody wants. And so, especially if it's in a good market, and so that's leading to prices to stay fairly competitive in many of those markets. Now, I think a lot of this is, the question is, who's buying these deals and for what purpose? And there are some folks that have, commitments of dollars they have to place. It's kind of, invest it or kind of lose it type situations. But there's also, an incentive, to do deals. For operators, they only make money. In fact, they lose money if they don't do deals, because they have an operational burn at their operations that have to be supported by doing deals. And the way that they forecasted, their own corporate budgets is, they thought they were going to do 3, 4, 5, however many deals a year, and looking at those acquisition fees and anticipating that you having those acquisition fees to meet payroll. And so all of a sudden you go from thinking you're going to do 5 deals to doing 1 deal, no deals, and that leaves a big gap. Then all of a sudden you might find yourself in a situation where it's like, we just need to do a deal. We just need to, it doesn't any kind of deal. We're just going to mess up people to do a deal, which that's how you can find some people doing some bad deals. And some of those have already happened. A lot of those already happened. Last year, people were in 2021, 2022. There are a lot of groups that paid, insane amounts, 2 caps, 3 caps. It's not worth going back and understanding the reasons, other than just a belief that things are just going to continue to grow at an exponential rate. And the money was being thrown at them. LPs were just throwing money at groups that had the deals. And so they didn't necessarily have to be that good. And especially if you could, throw a crazy low cap rate on it, you could make a lot of deals look not that bad. 10% rent growth, 20% rent growth in the first year or so. Well, it happened, so it's not impossible. But those same deals, if you drop a 0, replace the 20 with a 0, and replace the 4 cap with a 6 cap, the deals, they go from 15 to 8 very quickly, and some go to 0.
Well, and then the mindset is you'll only lose if you sell. And so that's, the last resort is selling. And it looks like, and that's what we've seen, is like right now this adjustment phase or this like financing phase is like this right now. People are reacting, doing what they can to not sell. The next stage, which could happen in Q1 or Q2 or 2024 maybe, is okay. All of that's been the workouts have been worked out, and now maybe people are going to have to sell. And maybe
they're not going to have an option.
But
again, if you were one of those people who overpaid in 21, 20, and 22, but you put a fixed rate loan on it, you don't really have a whole lot to worry about.
Yeah,
it doesn't really matter. I mean, your cash flow is what it is. Maybe it's low, but you're not losing anything. And the prices will come back. Now, it might take you 5 years or however long it might take, maybe longer, shorter. But you're not in a dire situation. But if you finance it with a bridge loan, typically a product that's used for a short period of time to just, because you're going to do a renovation, you're going to increase the value, or you have another loan that you're immediately going towards. But this was just it's going to be the quickest way to close, because that's how we can get the most proceeds. It's how we can, get the terms with the seller, because someone else is saying they can close quickly. It was just a means to an end to go quickly, because it just seemed like the money was free. It was free.
Yep.
And it was relative short-sighted. There's some great real estate, bought at too high of price, and it's got to get figured out what to do with it, because again, the reality is most didn't buy with long-term fixed rate debt. They bought with short-term floating rate debt that is coming due now and through the next year and a half.
Yeah.
And again, so I don't think it's today. I'm hoping it's 3 months, 6 months. But then I think a 9-month period, we are going to be at one of the best spots to buy, because the energy will be sacked out from many of the syndicators. They're just they'll have experienced a year and a half of low growth.
Even the process of being worked out, that's a strain. That's an additional financial burden.
Not fun.
And it's not fun. And it'll lower the threshold of the sales price until maybe there might be it will just be a factor of so many people entering the market.
Because there'll be large groups that have been out, and more groups are going to get out, and you're going to see less. So many people have come into the market because they thought it was easy. Well, people are discovering that it's not as easy as they thought, and so a lot of there'll be old market participants who are like, all right, I'm good. This is my last one, guys. Have a good one. There will be some that just started at the wrong time and kind of just hit it wrong, and some people are just getting started and they were like, "There's nothing to do here."
Yeah.
Some will stick around. In all those cases, there are some that'll still stick around, but there will be fewer folks around, fewer buyers at better prices in an environment where fundamentals should be really attractive.
Yeah. Fundamentals, the fundamentals a year from then will be attractive, but in the middle of 2024, it will look like
I'm saying
bit
in
of
26, and in 26, maybe end of 25, but it's probably not. It's not going to. It has to be good for a while to feel good.
Yeah.
It's going to be bad for a while. People will think it is bad when it is good. There's that hangover. Yeah. And that hangover is going to last for a while. People are just now starting to be convinced that it's bad. And it took a long time for that to happen. I mean, again, we're on, talking to everybody in the market, investors on LinkedIn. Everyone was like, very much bury your head in the sand up until like a couple months, like 2 months ago. And then now all of a sudden it's like, oh, there's dire straits here, and there's capital calls being issued because people couldn't hide it anymore.
Yeah.
Well, it's going to take an equally long time for people to come around to the fact that, like, all right, this market is hot.
Yeah.
Or it's getting hot, it's getting good. And we're kind of, again, don't want to say the good old days, but we're going to start seeing some good deals. And there's only going to be a handful of us around because, I don't know, we've got the,
and because, looking at
pills
a year and a half, in either direction of sluggish rent growth can't be great. And it's not going to
try plugging that into your model.
Yeah,
it doesn't look good. Again, show me your like a model. It's a normal syndicators model, and then plug in 0% growth in the year that compounds off of that. It doesn't look good. Not that you can't find deals with minimal rent growth that look pretty solid, but not
realistically,
not today, and not if you're buying at a forecast.
And that's another thing. You mentioned a little bit of the mindset and the types of buyers that are coming along, and maybe it's tax reasons or whatever. But it's getting fewer and fewer. I don't think that you can find like a gullible sucker of a buyer as easily as you could. But
I don't know.
Yeah, maybe at any time you can.
Certainly less buyers now than there were, but there's always a couple suckers out there, unfortunately. Or some people have just different angles and different perspectives and different goals and objectives. So it's not to each their own. There's a lot of groups will buy a deal and I'm like, I have no idea how you made sense of that. And then sometimes I do really well with it. And people say the same thing about us too. They're like, you went after that deal? I'm like, yeah, we saw a great angle at it. And which always excites me. But it also it should drive you to say, what are we not seeing about this deal? What did they see that we didn't see? What was the angle that they're taking to unlock all this value?
Yeah.
And it's not always you just look at a deal and you're going to underwrite an opportunity and you're like, well, let's just do what we did every time. We're going to, spend X amount on a per unit. We're going to fix it up and we're going to get some rent premium and then we're going to fix the things that are broken. Okay. I mean, sometimes that'll just work. And it's a first step, but like there's a couple of layers like to peel back of, how do we turn this, how do we make something that's greater than, exists currently today? How do you take something to the next level? And it's not always going to be the same cookie cutter approach. There's times especially in the industry where you can have a cookie cutter model, but it can be really dangerous too. I think it's great to have a template that you can adjust and tweak, but you have to be really discerning of, does this fit into the kind of the model, or is it, we have to make some serious adjustments? Because what I've seen happen in that situation is all of a sudden, you're copying and pasting business plans and they don't always fit. And all of a sudden, sometimes you're doing work that you don't need to do. Like, we're going to just renovate every single unit 100% with this finished package. But then it's like, this isn't right for the demographic.
Well, I was just going to say, you can't know everything.
Every market's different, every property is different, residents are different.
But that to me also is exciting to know, not just a market, but the market or submarket in a slice of time, and where a market might be, in the past and the future is really like, that's the cool part of imagining and speculating on some of these properties. And the fact is, like, and this is a great segue to our next article.
Oh, yeah.
The fact is that even the big guns like Blackstone, they don't know everything, and they are not equipped to address everything. So there is room for maybe the little guy, maybe a little bit more than Bloomberg might think. But that's just a half of that. A spirit of that is in my segue, which I do think was
segue.
Yeah. Anyways, so this Bloomberg article does talk about the big dogs or big players or big guys, whatever you want to call them. These titans is what Bloomberg calls them. Private credit titans. They are grabbing more than half of new deals. They are saying that about 58% of the total capital deployed by private credit managers globally is estimated to come from firms that lend more than $10 billion a year, according to a recent ACC report released last Thursday. And this, again, implication is that they're crowding out the little guys. And sure, these big chunks are going to be gobbled up by the bigger entities, but that 42% is nothing to sneeze at. And this is what I was kind of discussing this before, and I alluded to it, is that I think these bigger companies are probably set up to take down big deals, but not small deals. It's like, maybe picture like a giant. Yeah, they're great at scooping up entire, eating cows and big things, but they can't get a little tiny thing. They can't pick up a drumstick. Well, that's for me. I'll eat that. That's my dinner. sometimes you can be too big to grab some of these opportunities. And I think that it does bear a little bit of a logical similarity to this $10 billion company that may lack the capacity to analyze and pursue $1 million deals.
Well, yeah, it's not worth the time. It's the same reason why we don't pursue small acquisitions. Mm-hmm. It takes us basically the same amount of time to close a small deal than a big deal.
Yeah.
And so if you've got limited amount of resources, just not efficient to do small deals. But
if it's a one-man shop to pursue like a little quadplex, that's
sure.
Great.
Yeah, exactly. All day long, and you can find a really good niche in doing that. Mm-hmm. A lot of that. I mean, that's where on the preferred equity side. I mean, that's where we have a niche at Great Capital is writing checks kind of between $1 million and $5 million because there isn't really anyone else in that space doing. There's very few other participants in this space. Everyone wants to write a $10 million check or a $20 million check.
Yeah. So, these bigger players in the private lending space, they've got people ready to invest with them. And as this article also says that they're able to marshal more cash for individual deals. But I do think that there is room again for like these smaller problems that they don't have that unless they're running like a perfect symphony and intricate system, which they're not.
No.
I don't think that they just have the capacity to get these, maybe 1 million or 5 million or just a smaller deals. And even the examples that they pull, which are really useful, and I want to talk about in a second, the lowest dollar value is like $75 million. So, but this, and this is really interesting, and why I mentioned before that these interest rate pressures and the loan, like the lending strictness that we've seen in the past 2 years, it's not just in the CRE market. It's way more than mortgages. Yep. One of these deals is a loan for a take private of an online classifieds company. There's one about a loan for an energy company, one for compliance management software solutions, and then a few more about like acquisitions and stuff. I think some of these are just for operations, some are acquisitions, yep. Some there are lots of different reasons why people are needing money. And this is what Blackstone and Ares are stepping up to provide this capital to keep commerce flowing. If this is an adjustment period, if the CRE market is heading for asset valuation reduction, I wonder, is a similar thing happening? And when it comes to companies and the kind of corporate world,
it's a good question. I think in some ways it's already, looking at the tech industry, it kind of happened last year and then they're kind of recovering, but that's much more forward looking. And we're also looking at the stock market, which is, forward looking. No, but I think most of the economy is facing, similar pressure. I mean, most businesses, are generally, not finding it's the same, but are, in a very similar kind of credit environment and environment where credit is tighter, the same issues are showing up.
Yeah.
And, investor preferences are also, been moving around and looking for yields, but also, there's more competition from, treasuries and the like. So some of those yields on the private credit side also have to go up as well. Yeah. So those returns are starting to look attractive, especially in an environment where equity returns they've been good this year, but I think, there's uncertainty in the economy, recession. And so if you can get, double-digit returns from investing in corporate credit, those are kind of equity-like returns. And so, but with a lot more safety typically. So it makes sense to investors. Again, it's one of the reasons why we're looking at we're doing preferred equity deals right now is because, they feature returns that are very similar to equity-like returns, but with a much more attractive risk profile given this current environment. Not that there isn't a straight-up deal that could look great, but in the current environment, it's a much more of a sweet spot. In my opinion.
That is interesting, and how investors seem to be stepping up, and there seem to be this kind of continued need. I'm wondering if is this a transient moment, or is this going to be a feature of the kind of higher for longer environment that people are talking about? That
I could see it being much more of a cyclical move and being in this kind of period for a while where the bond market and the credit market just takes on a little bit of a different role in the economy, in markets. than it has played the last decade, where it played a new role because of how low rates were. And so it's more re-emerging the way maybe bonds operated in the late 80s and 90s, which I'm not an expert, but certainly different from the last decade. And again, there's a whole host of market participants and folks that are working in the industry that weren't alive during those periods of time. So it's going to be new for a lot of folks. A lot of the people who were alive and working in the industry, they're either a lot of them are retired or nearing retirement. Not all, but I'm not saying that everyone.
Regardless of whether you remember what happened before, in a previous interest rate regime or not, 15 years, we're talking like from 2008 to now. That's a long time, and that's a long time to form some habits and some kind of perspectives. So what the
roles are, and
if you're calling back on a previous, then like you're gonna have to shake some rust off and really reorient yourselves.
What did we do in the spring of '93?
Exactly.
I'm sure it's like this is kind of what it was like, but is the playbook, how dusty is the playbook? And, everyone has to kind of go through it again for the first time, even if you were there.
And and that's what I was looking. I was just looking at the interest rates and where they were in the early 2000s, and it was around like 5%. And that's, you just said that was a big signal for alarm for people. And so it's definitely going to take a lot of adjustment. And, like you mentioned before, it will look pretty bleak when, at first glance, and that may be where the investment opportunities are. And we haven't seen that this pain. People are still working out. What was really interesting, and what I was thinking about, was this idea of like due dates. And, these maturities are due dates, but they're also the beginning of negotiations. And so things are being negotiated right now, but that can't continue on forever. And the other emphasis that Newmark was making too in their reports on capital markets is like banks are having trouble too. The banks have to make sure that their balance sheets are, on the up and up, and they're getting strict. It's not just
Citibank. Citibank, I think yesterday announced that they were laying off, I forget how many people that eventually are going to lay off like 10,000 individuals.
So it's
financial service. They're going through a transition, to say the least. That could be an indicator for a handful of things. But
So all of these reports and articles, even Bloomberg, how it didn't touch on CRE, but I wanted to cover it because it represents this idea that these credit issues that we're talking about, mortgages and stuff, they're happening everywhere, and it's a nice provides a nice bit of context and provides us. It's pointing in the similar direction as the CRE markets, and we can kind of see a little bit further into the future. We're in the next phase. Still don't know when, what the phase after it, when that's going to hit. But it's refreshing to emerge a little bit out of this 2023 that was mired in uncertainty.
Still haven't had a recession yet. So, you got to, chalk it up a little bit of a win. Things could, again, Matt, and this is a good way to maybe wind things up. But it's good to be thankful for all the things that we have, the lessons we've learned, people in our lives. And that we haven't gone through a recession yet. Knock on
for
some,
real.
The trusty
particle board.
And this is good. So
okay, all right.
No, we have a lot to be thankful for. Multifamily investors. It's been an incredible run, and we're dealing with some bumps in the road. But if this is a surprise or unexpected, then it's a good idea to kind of relook at what the word kind of investing is, and what equity means, and nothing's guaranteed in life, and so we have to appreciate all the ups, but the only way to do that is to also appreciate kind of the downside in the downs as well, and because can't have the highs without the lows.
We're standing on the edge of it right now, it seems like.
And wherever we are in it, it's going to make a lot of us much better investors, smarter, better decision makers. But if we don't take the time to kind of appreciate all those things, even in periods of uncertainty, it's taking a step back, appreciating all the things that we have going on in our lives. And so again, Matt, thanks again.
I'm thankful for you.
No, thankful. We're going to include me in the best bosses submission.
Oh, that's getting submitted.
There was someone's group sent over there. Like, here's 3 recommendations of like some awards your company could submit to. And Matt was like, okay, the best company. He's like, I think I'm gonna get 2 out of the 3 of these, and but left off the best bosses.
Yeah, I said, well, we could do workplace one. We could do this one.
And you're like, I might not do this other one.
I paused a little too long before saying the best bosses, but we're chasing that down for sure.
It's not that I think I'm the best boss. It just seems like in these awards, you just have to you have to go for it.
Yep. Oh, we will. And for good reason.
Miss every shot we don't take.
That's right. Yeah.
Again, we can aspire to be better. Matt, thanks again. This is a great episode. Yep. Actually, kind of timely. We didn't even go over our limit. This is great. A lot of great stuff. Everybody have a great Thanksgiving. If you're listening to this before, after, if you're listening to after Thanksgiving, well, I hope that you are having a splendid time getting your holiday decorations, Christmas, Hanukkah, Kwanzaa, Boxing Day. It's all coming up. Anything else? New Year's?
No, just
do you guys have decorations up, Matt?
Not yet. We'll do post Thanksgiving. We've got a lot of decorative gourds right now.
Okay. Oh, you got some. It's very fall weather, so that's very appropriate. Yeah. Do you guys have a cadence for the Thanksgiving, Thursday on? Like, is there do you guys get a tree, or do you guys do decorations? Do you guys do anything over the weekend or Black Friday?
We don't set it. We don't do anything. We don't do anything specific, but it's generally like we will start the process of moving out the gourds, putting in the poinsettias, and just kind of get it.
So you guys do Thanksgiving. And we can go to your personal Thanksgiving plans later, but you get Thanksgiving on Thursday.
Totally.
1 or 2 Thanksgivings?
Just one this year.
Just one.
I'm at my wife's family, but maybe I'll stop by my family. Just
swing by.
Yeah.
Nice. It's always difficult. It's always hard. It's a lot of drama, a lot of logistics, a lot of people to please, a lot of opportunities to disappoint. And then you guys do anything like Friday? You guys see a movie, shop, do anything?
We don't,
or just keep it let's not do anything.
I think we'll be relaxing, but we might catch a movie. That's a good idea. Yeah.
I think we are planning on seeing a movie Saturday. I don't know what, but you're bringing the kids.
Yeah.
So it should be fun. Well, I hope everyone else has a stress-free holidays. We'll be right back the next week with the Gray Report, reporting live, just going to continue to crush it. Make sure you've liked, subscribed. If you aren't an accredited investor and you've listened this long to the episode, I always have to just bring that part up. Hop on over to graycapitalllc.com. Love to schedule a time just to hop on a call, learn more about what you're looking to achieve through multifamily investing. And if you're a multifamily operator, syndicator, or a lender, and you would like to discuss our new preferred equity program with the Gray Capital team, also get in touch with us. I think there will be a button on the website.
Oh yeah, we'll set that up.
Yeah, there'll be a button on the website you can press, and I'd love to just understand how we can possibly work together and find some really good solutions. We've got a whole toolbox full of solutions for sponsors that are facing some capital needs. You need a strategic capital partner step in and provide some much necessary capital. Avoid a not nice capital call. LPs do not like capital calls. Who wants to have? I mean, at some point, if you're in the business long enough, you're going to have a capital call on your record, just because that's how the business goes. But less is better, especially if it's unanticipated. So if you can avoid that, it's still a good deal. Preferred equity could be a really good solution. Good deals, though. And if you've got a bad deal, it's not good, don't call us. If you're not a good sponsor, don't call us either. But if you got a good deal, if you're a quality sponsor, we'd love to have a conversation with you. All right.
It's great.
Gobble, gobble.
Yeah.